So, hello. There is a first lecture of my playlist from basic to advanced CRT series. So this is the first video about key levels. In this video, I will talk about the key levels. That which key level I generally focus on to trade ranges, CRT ranges, and what is the logic behind that key levels, and where market usually form liquidity in the levels of the key levels. So let's talk about which key levels I generally focus on. So I just focus on 4 to 5 key levels like order blocks, order blocks, macro blocks, or rejection blocks, and FVG, the fair value. So this is the 4 key levels that I generally use to trade CRT. And one more key level, the 50% of the long wick. 50% of the long wick. Okay. So this is also a key level because everyone knows about the 50% of the order block, the 50% of the breaker block, the 50% of the fair value gap, and the 50% of the any other period. But no one talking about the 50% of the long wick. This is also a gap that market never leaves unfilled. Okay, so let's talk about the order block. So usually market in a bearish trend, let's suppose in if market put liquidity like here, let's suppose this is a bearish candle and another candle that engulfed by the bullish candle. Okay, so now what happen is market will come back to create another range just above the order block or sometime inside the order block or at the 50% of the order block. Okay, so you have to wait for a clear range to form, then you can trade continue high in the direction of the trend. So you can see market created a range, and now you can trade on the next candle. When market suit the previous range and take and by using these key levels, the order block. Okay, so this will be your CRT here, and you can continue. Okay, so this is the high time frame structure after a liquidity sweep. Okay, so when what is the logic behind this pattern or this key level and this range? So let's talk about the on lower time frame. So let's market generally creates a range. They generate interest on both side, buyers and sellers. Then after troubleshoot, they fly high. Okay, they break the consolidation area, and whenever market breaks the consolidation area, then we are looking to smack back into the consolidation area to create another range. Okay, then after so this range, then we can target, we can trade toward high, continue high. So this will be our range. Okay, so this will be arranged order block. This is the order block on the high time frame like this. Okay, and this is the expansion on the high time frame. You can see the expansion on the lower time frame. And after breaking this consolidation area, market will come back to form another range just above this consolidation area. Okay, so this will be your range, and always wait for a clear range to form, because market doing the same thing again and again, range expansion, range then expansion, then range then expansion. So whenever market form a range and expand, then always wait for another range to form to trade another expansion. Okay, so you can see there is a range low and this is the range high. So market created a range just above this order block and sold this liquidity and uh, just hit your key level, then toward high, continue high. So this is the basic structure of this order block on the lower time frame after liquidity sweep. So this is the logic behind the order block, and sometimes market form a range just above the opening price of the order block like this, but sometimes it happens market dig deep into the order block like this, at the 50% of the order block like here, create a range, then suit this range, then continue high. Why? Because they scares you uh, to close your trades, and it happens then most of time it happens when market create a model number one just by one single candle that dig deep into this order block. Okay, and sometimes market use rejection block instead of the order block, the body of the order block. Okay, why? Because they just engulf the whole candle by the one bullish candle. Okay, by one thick bullish candle. That's why they dig deep into the order block toward the rejection block, and there is a lot of liquidity on the order block. Okay, so now this is the logic. Sometime market happen from a range on the above the opening price of the order block, and sometimes it happens at the 50% of the order block, and sometimes it happens at the rejection block of the order block. So now this is the logic uh, behind key level, the order block. Okay, so let's talk about the gaps. I use order block, breaker block, rejection block for my entries, but I don't use a fair value gap for my entries. Let's talk about the gap on the euro US dollar. You can see the market created liquidity. So this is a liquidity. Okay, just see the key levels with the lens of liquidity, then you will understand the logic behind it. Okay, so now you can see this is the fair value gap, but I cannot target from this fair value gap toward this low. No, because this is the wrong way. Market use the gaps to generate liquidity and suit the liquidity. Okay, so in this scenario, what will market do? It form a range high, then market will suit this range high inside the fair value gap, then toward down side. Okay, to continue high down. You can see there is a order block that aligning with the fair value gap, then it becomes a high probability setups. Okay, so this is the fair value gap, and at the low or at the high of the fair value gap there is a liquidity. So always target a liquidity inside the key levels. Don't just look at the key levels and uh, press the buy selling button by just seeing the key levels of order block. Okay, order block, rejection block, breaker block. Always find liquidity inside the key levels. So this is the fair value gap. Now, what is breaker block? The breaker block is let's suppose the high, low, high, and the high that breaks the low. Okay, whenever that high breaks, then it becomes your breaker block like this. You can see this high broke this low, and whenever we close above from that high, then it becomes our breaker, because there is a specific candle, bearish candle, bullish candle in a bullish candle in bullish market, and there is a bearish candle in bearish trend. Okay, so you can see whenever we close above, so there will be a just single candle, and then it becomes your order block. So you can enter from that breaker block to trade continue high. Okay, so in the short wording, in bearish market, the low of the previous candle, when we close below from the previous candle, then the low of the previous candle becomes your breaker. Let me show you an example. You can see we close below from this candle, close below by the body, and then it becomes your breaker. Like if I shift on the lower time frame, you can see there is a breaker. Okay, low, and whenever it close below, then it becomes your breaker. So you can trade toward this from this breaker. Okay, to continue down or continue high, or just following your order flow. So just focus on the highs and lows, because highs and lows are your guideline. So don't focus on the previous candle's low and previous candle's high, because I just gave you an idea of the breaker block. So now you can see we have another PDRA, the rejection block. Okay, so you can see market created a order block. They generated an order block by closing above with the body. Okay, because body is the price and the wicks are the rejections. So you can see the market generated order block and rejection block as well. So what they did, they dig deep into this order block, even they hit the rejection block. Okay, so what market are doing, so I can expect this is the range inside this order block and rejection block. Then after this range, then they go higher, because we have higher prices because of this closing above candle. Okay, so this is the rejection block, and this is the part of the order block, because there is a three level of the order block: the opening price of the order block, the closing price of the body of the order block, and 50% of the order block. Okay, now you can see market rated orange even close above from the opening price of the rejection block, and they gave us a symbol of bullishness. Okay, so you can see there is 50% of the long wick, because sometimes this week, the previous week will be a long week, and the next week will be a short. But in this scenario, you can see where we have a long week, and the 50% of the long week and still unmitigated. Okay, so you can see this is our the 50% of the long week, and market created a range low just above the key levels. Okay, because if you focus on the ranges, highs and lows, it then you will understand the logic behind the PDRS. Okay, then you will able to find a valid key level to trade, CRT to trade range. Okay, now you can see we have order block, we have a rejection, we have 50% of the long wick, but I chose 50% of the long wick because market created a range low just above the 50% of the long wick. Okay, now you can see if I shift on the lower time frame like this, see, this is the range low, this is the range high. Okay, so what I'm expecting that market dig deep into this 50% of the rejection very long wick, then forward continue high. So you can see there is a order block for our order block that aligning perfectly aligned with the 50% of the long wick. Okay, so you can trade from here toward this high. So this is the simple and basic concept of the PDRS. Just don't look on PDRS. Don't target PDRS blindly. Just focus on ranges where market created a range. If they are created a range near the rejection block, then you can focus on the rejection block. If they are creating a range just below or above the order block, then you can focus on that order block. Okay. So now in this scenario, this order block perfectly aligning with the 50% of the long wick. So if I shift on the lower time frame, even a lower time frame like 2 hour, so you can see there is a fair value gap as well that perfectly aligning with the 50% of the long wick. So I can trade from here, stop loss just below the 50% the fair value gap, then the target is okay. So that's how I trade on TurtleSoup, and you can target your ranges low or range high by just focusing on PDRS or liquidity pool on the PDRS inside the PDRS. So this was the video about key levels. If you have any doubts, you can ask in the group. So don't force it, don't force the range, don't force the liquidity. It always be there because there is a quarter of the candle, there are 4 quarters of the candle, but I will tell you about in the next lesson. So this is just lecture about PDRS. Okay, so good luck and good trading. See you in the next episode.